A couple sat across from me last year with an insurance quote in their hands, $9,000 a year for a long term care insurance policy, and absolutely no promise that the premium wouldn't increase from there. So they were scared, and honestly, they had a good reason to be. Because a few weeks earlier, Gerald had had a small stroke scare. Fortunately, he's fine now, but it rattled both of them because they'd seen what a long term care event did to his mother and to the money she left behind. So they naturally did what a lot of careful people do. They called an insurance agent, they got a premium quote, and they came to me to ask if they should pull the trigger. And I told them no. Not because long term care isn't a real risk. It is one of the biggest risks in retirement, and frankly, most people underplan for it. But I told them no because that $9,000 policy, that was answering the wrong question. Because here's the thing nobody frames well. You have been handed two options that both feel bad. You either buy an expensive policy that might cost you more every year and then might never pay out, or you are left to skip it and hope. But those aren't the only two choices. There is a third one, and for a lot of people with real savings, it's the better one. I'm Brett Fellows with Oak Capital Advisors. Let me show you what actually pays for long-term care and the plan that Gerald and Faye built instead. Now, let me be fair to the insurance first, because I am not here to talk anyone out of a policy that fits. My mother has one. For some people, a traditional long-term care policy is exactly right. If your savings are modest enough that one long-term care event would wipe you out, but you're not poor enough for Medicaid, well, then a policy can be the thing that saves the plan. And that's a real group of people. And again, if that's you, buy it. But long-term care is not a yes or no question. It's a funding question. And frankly, the honest answer depends on how much you have, how it's positioned, and which one of you is likely to need care. And if you miss that, well, then you either overpay for coverage you didn't need, or you leave the surviving spouse exposed. So the issue here is a belief that quietly runs the whole conversation. And this is the belief that you either insure the entire risk or you leave yourself exposed. So you either buy the policy or you're gambling. But both of those extremes are wrong, and both of them cost people money. So let's do the thing that the insurance agent usually skips. Let's look at what actually pays for long-term care, because there are only a few real sources, and each one of them has a catch. So let's start with Medicare, because this is the one almost everyone gets wrong. Because people assume that Medicare covers long-term care. It mostly doesn't. Medicare pays for short, skilled stints, maybe a little rehab after a hospital stay up to a limited number of days. But the ongoing type of custodial care, those things like help with bathing, dressing, eating, the years-long kind of care that actually drains a plan, well, Medicare does not pay for that at all. And then there is Medicaid. So Medicaid does pay for long-term care and a lot of it. But you have to be nearly broke to qualify. So you spend down almost everything you have first. For a couple who spent a career building their real savings, planning to land in Medicaid means planning to spend it all first, and that's just not a plan. Which brings us to traditional long-term care insurance. It's real coverage, and again, for the right person, it works. But two things are true about it that the premium quote doesn't put in bold writing for you to see. The premium is usually not locked in. The industry mispriced these policies for years, and people who bought them a decade ago have watched their premiums climb, sometimes a lot. I can't tell you how many clients this has happened to. And also, it's a use it or lose it scenario. If you pay in for 20 years and never need care, well, that money is gone. You bought protection, not an asset. And then the last source is the one that Gerald and Faye landed on. So self-funding from an earmarked piece of your portfolio. And this is sometimes paired with a hybrid insurance policy that behaves differently than the traditional kind because it's flexible, and if you never need the care, the money is still yours or your spouse's or your kids. But the catch is you have to actually set it aside and position it on purpose instead of just assuming that the portfolio will absorb the hit. So you have 4 sources to pay for long-term care. 2 of them barely help you, and 1 works for a specific person. And 1 gives you flexibility if you have enough to fund it. And so the question was never policy or no policy. It's which of these fits you best. Here's Gerald and Faye. Gerald is 66. He recently retired. And that stroke scare I mentioned was minor, and he recovered. But it changed how they both thought about the next 20 years of their life. Faye is 64. She's in relatively good health. And here's the number that matters most to them. Statistically, she is likely to outlive Gerald by a decade or more. Now, between them, they have about $1.6 million saved, and it's spread across 3 different buckets. They have a pre-tax account, a Roth account, and a taxable brokerage account. Now, they're very careful type of people, and they're very good savers. And so they came in with this $9,000 premium quote and a simple question. Brett, should we buy it? So we looked at their actual situation instead of pulling out the insurance brochure. And 2 things stood out for them. First, they had enough money. With $1.6 million spread across those 3 different tax buckets, they weren't the couple who gets wiped out by one long-term care event. They could fund a serious long-term care need from their own money if it was set aside deliberately. A traditional long-term care policy for both of them at $9,000 a year and climbing would have them paying well north of $200,000 over the next 20 years for coverage that they might use a fraction of or never. And second, the real risk wasn't the long-term care premium itself. It was what a long-term care event would do to Faye. So if Gerald needed 3 or 4 years of care and they were able to pay for it by pulling hard from the wrong accounts in the wrong order, well then Faye, the one likely to live another 10 or 15 years alone, well then she would be left with a cut down in income and a drained portfolio. The long-term care event, it ends, but Faye's retirement doesn't. And that is the exposure that actually mattered. And the $9,000 policy was not aimed at that. So I told Gerald what I'll tell you. The instinct to protect Faye is exactly right. The $9,000 policy was just the wrong tool for the job they actually needed done. So the misconception isn't that long-term care insurance is overblown. Yes, it is real and it is expensive, and Gerald's family lived through it from their past experience. The misconception is that the only way to handle it is to insure the whole thing. But when you have real savings, you don't have to transfer the entire risk to an insurance company at a rising annual price. You have to structure a piece of your own plan so that a care event, even a long one, doesn't sink the person who is left behind. So that shifts the whole question, because now it stops being how much insurance do I buy and instead becomes, well, which slice of what I already have do I set aside for this, and how do I protect the survivor first? What I built with Gerald and Faye, I call the Care Reserve. And the idea is very simple. Instead of insuring everything or just ignoring the risk, you carve out a defined slice of the portfolio and you earmark it for a possible long-term care need. And you position it in the accounts that stay flexible and tax-friendly. And lastly, you're now able to protect the surviving spouse's income before anything else. So you're not betting the whole plan on a policy. You're not leaving it to hope either. You are setting aside a piece of money on purpose that can flex to a long-term care need if it comes and stays yours if it doesn't. So the shift is from buying a product to building a structure. So same worry that Gerald walked in with, but it's a very different answer for them. So here's how the Care Reserve worked for Gerald and Faye in order. So the first move is the one that most people skip, even though it matters more than any insurance policy. So move number one is you lock the surviving spouse's income first. So before we talked about long-term care at all, we locked Faye's income floor for the rest of her life. When Gerald dies, one of their 2 Social Security checks will go away. And if a chunk of their income was tied to him, well, Faye could see her monthly income drop right when her expenses might be the highest. So we mapped a guaranteed income floor for the survivor using Social Security claiming timing and a stable income base so that no matter what happens to Gerald, Faye's core income holds steady for her entire life. And that's the foundation. A long-term care event should never be allowed to cut the check that the survivor needs to live on. And then for move 2, we earmark the reserve and we put it in the right accounts. So then we fenced off a slice of their portfolio as the long-term care reserve. And for them, this was roughly $300,000 to $400,000. And we held it in the Roth and the taxable brokerage accounts, not the pre-tax accounts. And that placement matters because if Gerald needs care, and they have to spend from the long-term care reserve, and they're pulling from the Roth and the taxable buckets, well, that means they can fund years of care without spiking their taxable income, or perhaps tripping a Medicare surcharge, or more importantly, dragging Faye into a higher tax bracket in the same year. So the reserve sits there invested, doing its job as part of the portfolio. And if the long-term care need never comes, well, that money was never lost. It's still theirs and eventually their kids. And for move 3, we use insurance only where it earns its place. So here's why we didn't rule insurance out. We just aimed it. So Faye is younger, healthy, and the one statistically most likely to need care someday, and to be the survivor paying for it alone. So for Faye, we looked at a hybrid policy. This is the kind that combines life insurance with a long-term care benefit. So it behaves differently than the traditional long-term care policy that Gerald was quoted. So if Faye needs care, it pays for care. If she never does, it pays a death benefit instead. The money just doesn't evaporate. For them, a small piece of insurance on the right person set next to a self-funded reserve, well, this did the job better than a big traditional insurance policy on both of them. So by the end, Gerald and Faye had no $9,000 premium climbing every year. And they had Faye's income locked in for life. They also had a long term care reserve of a few $100,000 positioned to fund a long care event without wrecking the tax picture. And then they had a right sized insurance policy pointed at the person most likely to need it. So the same 1.6 million that they walked in with, structured so that a long-term care event is a problem that they can absorb instead of a crisis that sinks the survivor. Now, here's the honest trade-off, because there is one. Self-funding means that the risk is partly yours. And if both of them needed long, expensive care at the same time, well, a reserve can be stretched in a way that an unlimited insurance policy wouldn't be. And so that's real. And for some people, that combined risk is exactly why a traditional policy is worth every dollar. But Gerald and Faye had enough savings and the right health picture to take that trade-off. But a couple with less saved or two spouses in poor health, well, they might land the other way and be the right person to buy a long-term care policy. So that's the trade-off. There is no single answer that fits everyone, which is the whole point. So if you are staring at a long-term care quote and it feels like a bad deal either way, that's because the two options you were handed aren't the only two. The right answer depends on how much you have saved, how it is positioned across your accounts, your health, your spouse's health, and which of you is likely to be the one left behind. So that's not an insurance quote. That's a conversation. And it's the kind of thing we work through with the people that we plan for. If you're near retirement with a meaningful pre-tax retirement account balance, and you want to see how we think about long-term care with you and whether working together is a fit, go to connectwithbrett.com and pick a time. I am not going to hand you an insurance policy on a first call, but I will give you a straight read on where you stand. So Gerald walked in with a $9,000 insurance quote and a real fear, and both of those made sense. But what changed wasn't the fear, it was the structure. He protected Faye, set aside a reserve, and pointed a little insurance where it mattered, instead of insuring everything or hoping for the best. Long-term care is a real risk. It is just not a binary one.